finance, a la shmup. What is backdating? Ooh, this is bad. Scandals, jail, Silicon Valley soap opera. When an important employee is hired by a young company, they might get a generous option plan for company stock and a more modest salary and bonus plan. Why? Because young companies don't have a lot of cash today, but want to attract good workers, and they're betting on the fact that employees will be tempted by the possibility of making millions from those options. Well, there are usually some limits with the options. For example, the employee might have to stay in good standing at the company for 4 years, and they must sell their options within 10 years or so of them being granted. So far, so good, but these options must also come with a strike price, which is the price at which the employee can buy the stock, and that's where things get sticky here with backdating. Well, how is the strike price created? Well, if a company's already publicly traded and then options are being granted, that strike price is usually derived by looking at the average closing price over the last 120 days or so of trading, or something like that. Some shady companies and employees realized that they could backdate their options, which means slapping on a price from a date a few days, a few weeks, or a few months earlier when prices were way lower. So instead of a strike price of like $20, they might have a strike price of like only $15 and have $5 free of market ride on everyone else's nickel. Getting that lower price by fudging a few dates means bigger potential profits for the employees, who will eventually then sell their stock and take the gain from whatever it sells for down to whatever the strike price was that they paid. There's just one tiny problem with all this. Backdating is illegal. In 2008 and 2009, though, it didn't prevent some big backdating scandals in Silicon Valley and put a few people in jail. And since then, laws have gotten a whole lot stricter.
Illustrative example time.
Yachts and Things stock was at $80 a share 20 weeks ago. Now it's at $200. In 4 years, it might be $400. At least that's what Morgan Stanley says it'll be. The employee getting the $80 strike price on 100,000 shares will have appreciated $320 per share times 100,000 shares, or $32 million worth of appreciation. That's a whole lot of appreciation. But if the employee had received as their strike price the average of 280, those are the stock prices, assuming an arithmetic set of closing price gains, well, then the strike price on their options would have been 140, not 80. The gain would then be only an appreciation of $260, not $320. It's a big difference when you multiply it by 100,000, right? So yeah, you don't want to miss out on that extra $6 million. That's like a dozen of these bad boys.